well as our firm here in Springfield for the last 7 years, and they are some of my favorite clients, so they are awesome. And I'm really happy to be here with you guys today. Kelly's my favorite. No. So just a little bit about my background. Aside from accounting, I spent my first career, pre-kids, in process improvement and development. So as you guys are talking about creating your 30-day checklists and all that, that's like, oh my gosh, that's like, ooh, so exciting to me. So process improvement, process development, and then accounting are kind of my two areas of expertise. The topic today, like Chris said, can get really heavy. We can get really down into the details, and we're not. We're going to keep it kind of light. We're going to go through some terminology. We're going to talk about what the tax advantage is for real estate professionals, and then we're going to do a little bit of scenario play. And Chris is right, I'm really conservative. And mostly it's because I don't ever want to give you a number that I don't think you could achieve. So the scenarios we talk about today are going to be super conservative, and I'll keep saying that over and over again. And as Chris and I kind of talked about the presentation, we recognize that this is a topic we may have to come back to, or it may be a topic that if a small group of you want to pursue, we can pursue it in more depth if it's not applicable or of interest to everybody. So the first thing is real estate professional. This is one of those things that people throw around the term real estate professional. You guys are real estate professionals. You work for a professional real estate company. You are in property management. You buy and sell. But the IRS has a really different definition of what a real estate professional is. So I want to go through that because this is one of the key things to taking advantage of this tax break. So there is no requirement to be a licensed real estate agent. The IRS does not care if you have your license. What they care is that you are completing the amount of time and the activities that they require. So a couple of things. They want you to spend more time in real estate activities than non-real estate activities. We'll talk about why that's important later. You guys all qualify. You have to spend at least 750 hours per year in real estate activities, which means you have to be at least a 40% FTE. And you have to do both these things. So if you're working for Chris for, we'll just say 800 hours a year, which is just shy of half-time, but you have another half-time job that's more hours than you're working at Roost, you wouldn't qualify for this. So if you're here 100% and this is your full-time job, you're in the clear. Like, there's no problem. But again, you must meet both 750 hours of real estate, and it has to be your primary time commitment. The other benefit, though, is if you are married and filing jointly, it only has to be one of you to take advantage of this. So if your spouse is a school teacher or works retail and you're here, you both get this tax advantage as long as you are filing a joint tax return. The other thing we hear a lot about is investment properties versus second homes, and I'm going to totally throw Chris under the bus on this one because he asks me all the time about, is my second home, can I use it, can we have a second home, can we have an investment property, can I have both? No, you can't have both. But for the non-real estate professional, or as you're talking to clients as they're contemplating second homes or investment properties, that's why I bring it up today. I think it's really important just to understand a couple of the nuances, and again, how the IRS would define an investment property versus a second home. So obviously an investment property is not your primary residence. You're purchasing this for the sole benefit of making money on it or holding it or taking advantage of this tax advantage. It can be residential or commercial, doesn't matter, and it can be flip homes. So if it's something you are planning on holding for a short period of time, that's your investment property. Versus your second home. Your second home, you intend to occupy it for part of the year. And we all know what a vacation home is. It's kept for your your exclusive use. If you took the mortgage out on it, it's for your use. You really don't intend to make it an Airbnb, you don't intend on making it a rental. However, the IRS does say your second home can be rented tax-free for 14 days per year. So if you do have a condo in Florida, or you have a second home somewhere and you want to rent it out for up to 14 days, you can take that rent tax-free. But anything after that, and again, the IRS is not asking you to send in a log, but if you start showing, you know, if you were to ever be audited and they find it on Airbnb, it's no longer a second home. Second homes also do get the advantage of you can deduct property taxes and mortgage interest like you do on your primary residence if you can itemize, and that kind of changed how many people do that with the tax changes last year. But that's where the IRS says, look, if it's a second home, you get to treat it like a second home, and if it's not, you have to report that rental income. So again, not probably as important for this group because we're more focused on knowing those differences, but just a little bit of clarification. So this is something that I really had to dig into as I started working with Chris and Kelly because of the real estate professional designation is active income versus passive income. And we'll talk about why this is important later, but your active income is the money you physically work for. If you don't work, you don't get paid. So these are your W-2 wages, your 1099 wages. This is, you have to actively be working in order to pursue your income. All of us have active income based on the fact that we're here and Chris is paying us. Passive income is the money you earn without working. It's the interest on your savings account. It's dividends on investments. It might be a retirement annuity. Rental income is considered passive income. And people argue, no, rental income's active. I had to go out and buy a property. But you bought it once, you did one active thing, and now the income keeps coming. The income keeps coming whether you're not buying that property every month. And so rental income is considered passive, and this will be important when we're talking about the advantage for real estate professionals. Any questions so far? Am I going too fast? I mean, is this stuff you guys like kind of already know? I don't want to assume you know it, but I also didn't want to assume that nobody knew it. You're good. Okay. So now we're going to get into kind of the tax language, depreciation and amortization. And we'll talk about this. Again, this plays into where we get the advantages for real estate professionals. Depreciation is taking an asset. In our case, it will be buildings and improvements, and expensing it over the useful life. You cannot buy a property for $100,000 and take $100,000 worth of expense in the first year. The IRS just doesn't allow you to do that in businesses. For depreciation, it's a tangible asset. It's something we can touch, it's something we can see, and it's something that we can sell when we're done with it. So it has salvage or resale value. And then there's two different ways you can take your depreciation expense. Straight line, which means you say this property is good for this many years, you take the purchase price, you divide it by that many years, and you get a set amount every year. Or accelerated depreciation. And this is where we could go like really deep, and I could bore you all to tears about all the different kinds of accelerated depreciation, but it means you get to take some or all of the value up front, so you get the expense faster. Amortization is intangible assets. Closing costs, franchise agreements, goodwill, trademarks, all those things that cost us money to make these transactions happen, but you can't touch it. You can't touch the closing costs, you can't touch the franchise agreement, and at the end we have nothing to sell. So you can't sell the closing costs with the house. So because you can't touch or feel or see these, you cannot take it any faster than what we call straight line depreciation. And we'll show examples of that in a little bit. So there's no salvage or resale at the end. The other one I didn't put on here is land. You cannot depreciate or amortize land because in the IRS's eyes, land always holds its value or it's appreciating. Now we could argue that all day long that land does not always appreciate, but there's a set amount of land, and so the IRS says you cannot expense or depreciate land. So just a quick example of some straight line depreciation, and we're going to use this residential building example throughout the whole presentation. And this is where Chris is like, you're being too conservative on my numbers, but we're going to use this number because it comes out nice and even at the end. So if you buy a residential building for $50,000, the standard is 10% of that building purchase price is land. That's what our firm, that's what the IRS would consider standard. So if you buy a building for $50,000, $5,000 of that is land, and we will not be able to depreciate that. You'll always have that as an asset of $5,000 for the land. So your building is really worth $45,000. And then we're going to say it needed $5,000 of immediate improvements. Yeah?
But if you buy a property that has a lot of land on it, that's like way more than 10%.
Then we would negotiate. But if we're buying standard residential,
With the IRS, you negotiate.
well then we could put it in your tax return. You would put it in as more land than building.
But you prefer not to do that.
You prefer not to because you want the expense, yeah. And sometimes we will look at what the auditor's rolls list as value of the land, and so if the auditor would show that the land is worth 90% and the building's worth 10, we'll use that ratio. Typically, we just use a 90-10 ratio. But you're right, if you're, and farmland is a whole nother story, we're not even getting into that. We're just kind of talking about your standard residential properties. Improvements. In this case, we're doing $5,000 of improvements. Improvements are anything you have to do to make the property usable. Improvements are roofs and driveways and paint and carpet and appliances. Anything that you would need to make that property sellable, rentable, usable. Closing costs in this case are $5,000. I know that's probably not right, I just used a round number. And in this case, we're going to take out a 15-year mortgage. So for depreciation on this particular property, the land gets us no depreciation. Can you guys see over there? I'm sorry. The building is worth $45,000. Buildings, according to the IRS, if they are residential properties, have a 27.5-year life. Don't ask me why it's 27.5. But, so they expect you to depreciate or take your expense over 27.5 years. Improvements, most of the time the IRS wants to see a 15-year life. A roof would last, give or take, 15 years. A driveway would give or last 15 years. Appliances, furnaces, air conditioners, that's a whole nother story, and we can get into more detail on that. That's where I said I don't want to dig too deep. You can take some of those things faster, but we're just going to kind of generalize at 15 years. And then closing costs. Our closing costs were $5,000, and because it's a 15-year mortgage, we have to take those closing costs over the life of the loan, which is 15 years. So if you bought this property for $50,000 and you did just straight, I want to take the same amount of expense every year, you would get $2,302 worth of depreciation expense every year on this property. Questions? Did I go too fast?
So the cool thing about that is if you collected rent and paid the bills,
We're gonna
all
get
right.
to that. That's ahead of me all the time. So then I said there's accelerated depreciation. Accelerated depreciation applies most to improvements. So right now, and this literally changes every year with the tax code, we have what's called bonus depreciation. There are certain categories of assets that you can take all the expense in the first year if they are new assets. So in this case, our $5,000 worth of improvements, we're going to take all $5,000 in the first year. So we put in $5,000 worth of kitchen appliances and carpeting and flooring in this house before we put it on the market to rent. We're going to take all $5,000 this first year. So this first year, we get $1,636 of depreciation for the building. We get $5,000 for improvements, plus the $333 for closing costs. So this first year, we get $6,900 worth of expense. Any questions? Yeah.
So you're depreciating your expense that has nothing to do with what it's appraised at or what it's
Correct.
assessed at? Or
Nothing.
what its
No,
value is?
doesn't matter. It's all based on the purchase price. How much cash or mortgage is this? Yeah, doesn't have anything to do with appreciation.
Which one's more popular?
It really depends. It's my very legal answer. It really depends. If you are in this, if you're going to hold this property for a really long time and you want expense every year to help offset your rental income, you might want to consider a straight line because you'll get that $2,300 for the next 27 and a half years or until you sell the property. If you think you're going to be buying a property every year and you're going to have a lot of income, but you're going to have a new property every year to bonus your depreciation out, most people will take the bonus so they can get as much expense up front as possible. The other reason to do it is, if the theory is that we all pay higher tax brackets when we're younger, right? We all make more money when we're in our 30s or 40s or 50s. Once we hit retirement, we don't usually, as a general rule, have more income. We're living on a little bit less. Our tax bracket goes down. When you want to take the expense when you have the higher tax rate because you're saving more money. And we'll see that in a later example. So a lot of times people will take the expense in the first year as much as they can just because they want to save as much on that tax year. So where's the benefit for you guys? As a qualified real estate professional, you can deduct all of your rental losses. Remember, that's passive income. You're not actually working for it. Well, you are. I know you are, but the IRS doesn't think so. You can deduct all of your passive income against your non-passive income if you or your spouse qualify. Most people, I'm one of them, if I have a rental property and it loses money, I can only take the loss to a certain point. I can't then reduce my W-2 wages or earnings. I have to let that loss move forward. It's called rolling it forward, carrying it forward. And we'll talk about that. So this is where, as real estate professionals, you get the advantage because you can take that, all of the loss, no matter how big it is, each year. I couldn't.
So anything that it's perverse, but I want to lose as much money as I can on the rental property so that I can take that loss and offset anything I make selling houses. So it reduces my tax bill right now.
So a real estate, we're just going to use this kind of generic. We make total $150,000 a year. And this one says net rental losses of $50,000. As a real estate professional, your taxable income is now $100,000. As a non-real estate professional, my taxable income is $150,000.
That's an unfair advantage.
That is the unfair advantage you all get.
We get one.
We get one.
We get one. So we'll keep digging into this. So again, we're using that $50,000 example. It's a $50,000. It's $5,000 in land. It's $45,000 in building. Okay, that's all the same. Let's say this property the first year generates $6,000 in rental income, but there were $15,000 worth of expenses. Because maybe you didn't get this on the market until October, but you've been mowing the lawn all summer. You've been paying trash bills. You've been paying water bills. You had to market this. You have to pay property management fees. You have to pay real estate taxes. So at the end of the year, you have $6,000 in income, $15,000 in regular expenses, and then you have depreciation expense of either straight line or accelerated. So this property did not make money this year, did it? No. Chris is like, yay!
But it's safe.
Yeah. So here's, you guys are on that side, and I'm over here. Let's say our spouses and us combined had W-2 or 1099 earnings, however you make your living, of $150,000. Well, that property lost $9,000. Remember, it had $6,000 of income, but $15,000 of expense. So it lost $9,000. And then there's $2,300 of depreciation, because this is the really conservative slow rate. Your taxable income's $136,000. What's mine? I'm still at $150,000. So the tax rate, you guys would pay $30,000 in income tax. I'm paying $33,000 in income tax. We own identical properties. The only difference is you're a real estate professional and I'm not. So you guys save $2,500 on your annual tax bill versus me. That's just the boat. That's just straight line, taking it every, nice and slow over 27.5 years.
That number actually gets bigger too, because,
Well, this is one property. Remember, this was just
Yeah.
one property.
and it's a $50,000 property.
Right.
Yeah, I mean, it could be a lot
Yeah.
bigger. Yes, Zach?
Is it possible for, that to put you in a different tax bracket, or do you start in a tax bracket?
Well, I picked an example where we stayed in the same tax bracket, but yes, it could. If you lose enough and it knocks you to the lower tax bracket, you'd have an even bigger advantage.
Yeah.
So,
And remember, I don't think that 30,000 takes into account whatever your standard deductions, right?
correct. We're very much generalizing. We're saying this $150,000 is like, all right, that's what we're putting our tax off of. So there's itemized deductions you can throw in here. You guys get to deduct your realtor dues and some of that. You might have business expenses from, we're not including all of that
Car
today.
expense, your cell phone.
Right, but that's what gets you down to we're gonna say that's what gets to the $150,000. That's your taxable income.
Yeah, it's huge.
And again, this is one property and it's a very conservative property. It gets a little bigger if you take your depreciation faster. So in this case, you guys took all the bonus depreciation, so you got $6,900. I still just took straight line because I'm really conservative, because that's my nature. But at the end of the day, you guys saved $3,500 on your taxes this year. Over me.
For $150,000 house.
For $150,000 house. So here's the other way this
Then you
works.
could have gotten a loan on the bottom.
Yeah. So for me, I have these losses that I get to, it's not like the IRS says, well, you don't ever get to see those again, but I have to carry them forward. So if next year my property makes money, the IRS would let me at least zero that out with the loss from the previous year. You guys just get to take it all every year. You don't have to have this carryover rolling forward account. Here's the other little trick we figured out. So if you have properties now, make sure that you check the real estate professional box on your tax return, or your accountant is checking the box. Because if you check the box, even now, it will go back and you can take all those carry forwards this year. Remember when we did that for you? We did that the first year we did your taxes. There was a couple property, and it's property by property. So what had happened was they bought some new properties and the box hadn't gotten checked on one or two properties, and when all of a sudden they got all the past all the losses that have been carrying forward, they got to take in that year. So if you already have rental properties or investment properties, make sure that box is being checked if you qualify as a real estate professional. And again, it's property by property. It's not like on the front page of your tax return. It's each property. Is this an investment property? Is the individual owner a real estate professional? Yes.
So should we recommend to our investors to become a real estate professional like once every 5 years for part-time?
No.
That's our job.
It sounds like if you can add up all those up and put all those losses.
But again, the IRS is going to want to see you're working 750 hours, plus it has to be more hours than your other jobs. So if your investors are attorneys who work 80 hours a week as an attorney and yet they have properties, they're not real estate professionals. Now, if you're a real estate attorney, you could probably argue that. But we'll use a doctor. Several of the doctors in town own their buildings, but they're not real estate professionals, even though they own their building or maybe they own other buildings, because their primary active income is not real estate.
I just mean like if they have properties that are accumulating carryover losses for a decade, like
No, because honestly, if they're doing that and there are other codes on your tax return that code what you do and what your profession is. If they aren't matching up, they'll get red flagged. And that is the last thing you want. You don't want to go through an audit because you were trying to take advantage.
No, I mean, genuinely be like, okay, for 51% of 1 year out of every 10 years, you have to genuinely be a real estate
No, you have to
professional.
genuinely be it every year.
Oh, okay. I
Yeah.
thought they carry forward and then in 1 year you could.
So what happened is Chris has always been a real estate
Okay,
professional, and somebody didn't check the box when we
That
corrected
was my
it.
whole account.
I got you.
Yeah, I think that was 2 accounts ago, actually.
Yeah.
But, you know, but what I'm saying for you guys, because you all qualify, and you've probably all qualified for several years, just make sure those boxes are being checked. So did it, like, does this kind of make sense? Do you see where the advantage is? Again, it's really simplified. The other advantage is that those carry forward losses, you can take them in this year, especially if you plan on holding those properties. Because again, if you're gonna hold these properties into retirement so that this is what's funding your retirement, you're hoping you're in a lower tax bracket then. So take it now, because 22%, that's actually a pretty low tax bracket. You know, tax brackets right now jump from 22 up to 34%. Well, that's 8%. It's a big difference if you can take that 5,000 or that 10,000 or whatever that loss is all this year. So that's what I have. I know there's questions, and I know you're going to start thinking about it later. If you have questions, please feel free. My email, my phone number, Chris and Kelly always know how to get a hold of me. I'm happy to answer questions. I'm happy to answer specific questions if you have specific questions, or if you just want to know more. I'm happy to do that for you. So thank you so much for letting me present. I hope this is helpful.
Questions they can ask?
I just have a question, Joe. Is there do the IRS ever flag anyone, like, for instance, say, if you have a rental and then you take a loss every year for like 10 years and you've never, is there ever a limit where they'll go?
Not really. So the other thing to remember about depreciation, if depreciation is what's throwing you into a loss, that's like considered like a non-cash loss because you didn't actually,
Oh, okay.
you know, so even a lot of times when you go to the bank for loans, they will ask you, they will say, well, add back depreciation because that's really what the property cash flowed. That's really what it made or lost.
Right.
Because that's a non-cash expense. No, I mean, I see properties all the time that have never really made money, and part of it is the market. You know, I mean, the IRS does know markets, they do look. You know, I don't think, and they will pull it up on an auditor's site too, you know, and be like, oh, this property really, it's in a neighborhood and, you know, it's been held and it's not being flipped. I mean, they do their research ahead of time. So I've not had anybody flag for that. Any other questions? Do you have anything else to add?
No, Jill, thank you very much.
You're very welcome.
Thank you.
Thank you.